Welcome to CatEye U.S. stock. We watch markets with calm focus and sharp instincts. It's Wednesday, January 14th, 2026, and the market just reminded you it doesn't care about textbook macro perfection. Retail sales are firm. Core PPI is flat. That's a Goldilocks setup for the Fed. But the tape still went risk-off. Financials and mega-cap tech took the hit, pulling the S&P and the Nasdaq lower as regulatory shock and execution risk overwhelmed the good economic news. Look at the S&P Heatmap and the story sharpens. Big tech and big banks are deep red rectangles, heavy and dragging. Microsoft, Nvidia, the money center lenders, all leaning lower. But you still see vivid pockets of green: utilities, consumer staples, Intel, AMD. That's not a market-wide exodus. That's capital stepping away from the biggest, most policy-exposed boxes and hiding in smaller squares and defensives. So where does that leave the bigger picture? Under the red index print, breadth is actually rotating. Money's leaking out of crowded AI platforms and big banks, and turning up in small caps, utilities, staples, and select chips. That's the tension now. The rally can survive if new leaders carry the load, but the tape's clearly done giving a free pass to concentration, high multiples, and regulatory risk. And that sets up our stock stories. On the rumor side, desks kept talking about super microcomputer. No big headline, no confirmed catalyst. Just a sense that SMCI, as a high beta AI server proxy, is trading in sympathy with the AI hardware complex. The chatter's simple. If SMCI keeps cooling while other semis rotate, that could be an early tell that AI enthusiasm is shifting from story stocks to more established chip names. Again, that's chatter, not a firm signal. President Trump has proposed a $1.5 trillion U.S. defense budget for fiscal year 2027, a jump of roughly 50% from 2026 levels. If it's approved, this would be one of the largest military spending increases in modern U.S. history. On the surface, that's a clear positive for defense contractors like Lockheed Martin and Boeing. Bigger budgets typically mean more weapons procurement, faster production, and longer backlogs, especially for missiles, aircraft, and maintenance programs. But this story doesn't end with more money. Alongside the budget proposal, the president issued a new executive order demanding that major defense contractors prioritize production speed and maintenance readiness. At the same time, it pressures companies to cap executive pay and restrict stock buybacks and dividends, making sure cash is directed into factories, supply chains, and research instead of shareholders. That changes the investment calculus. For Lockheed Martin, a stock prized for steady dividends and buybacks, the risk is that capital returns can become conditional on government performance reviews. For Boeing's defense business, which has faced execution challenges, tighter oversight raises the stakes even higher. So investors are caught in a bind. Bigger defense budgets point to growth, but tougher oversight limits financial flexibility. The bottom line is this: this policy shift favors national security and industrial capacity, but it introduces new risks for shareholders. In today's defense trade, execution matters more than ever, and the government's making that clear. JPMorgan was the cleanest read on the bank shock. The company beat earnings, but the stock still sold off hard as traders focused on President Trump's new executive order, capping credit card interest rates at 10% starting next week. That policy move forced investors to rethink future lending margins, and JPMorgan became the poster child for how quickly regulatory risk can overpower solid fundamentals and drag the whole financials complex lower. Microsoft was another big casualty. As part of the mega-cap tech unwind, investors took profits in richly valued AI and cloud names, and Microsoft's size made every tick matter for the S&P and the Dow. The message from the tape is blunt. Even the highest quality platforms aren't immune when the market decides to trim concentration in its most crowded AI winners. Nvidia and Intel told the rotation story inside chips. Nvidia traded lower again, as capital stepped back from the market's premier AI leader, reflecting concern about stretched expectations and crowding. Intel, by contrast, ripped higher after a fresh KeyBank upgrade to overweight with a $60 target, extending its turnaround narrative. Side by side, that's the market saying it still wants AI and compute exposure, just not all in one expensive name. Amazon slipped in step with the broader mega-cap tech de-risking. There wasn't a fresh company-specific bombshell here. This was about investors methodically trimming richly valued growth and big index weights ahead of the heavier part of earnings season. For a name that anchors both e-commerce and cloud sentiment, That softness reinforces the idea that the market's finally pruning its most crowded leadership trades. On the other side of the trade, Procter & Gamble was a quiet winner. The stock climbed as part of a broader bid into consumer staples, with investors clearly favoring defensive, dividend-paying balance sheets, while banks and big tech wobbled. PG's move helped confirm that today's risk-off wasn't about abandoning equities. It was about reallocating toward low-volatility, recession-resilient franchises. Away from stocks, the metals complex sent its own message. Gold and silver carved out fresh record highs as investors buckled on hard asset seatbelts. With banks under regulatory pressure and big tech facing valuation stress, that steady bid for metals lines up with a market that wants hedges and diversification, not just cash. Equities only pulled back modestly, but the new highs in metals underline how seriously investors are taking policy and execution risk. The Russell 2000 quietly pushed the so-called Great Rotation story forward. Small caps held up, even as the S&P and the Dow felt the weight of banks and mega-cap tech. Flows into more domestically oriented, economically sensitive names suggest investors are still willing to take risk, but further down the cap spectrum and away from headline policy crosshairs. How long that divergence lasts will tell you a lot about whether this rally can truly broaden out. Looking to tomorrow, the big swing factors are still policy and yields. The bond market barely flinched at soft PPI, keeping the 10-year near 4.15% as it digests that $1.5 trillion defense proposal and the new credit card rate cap. As more banks report, guidance on margins and consumer health will matter as much as the prints. And for tech, any break higher in yields could force another valuation stress test. This tape's no longer rewarding broad growth stories. It's rewarding clean balance sheets and punishing idiosyncratic risk. To wrap it up, today wasn't a vote against growth. The consumer's still spending, and core inflation's cooperating. What changed is how selectively the market's willing to own risk. Banks paid for regulatory shock. Mega-cap tech paid for concentration and lofty valuations. Defensives, small caps, and hard assets picked up the slack. Into the next session, keep your eyes on yields, bank commentary, and whether this rotation can keep broadening out. That's where the next leg of this market gets decided. Thank you for watching CatEye U.S. Stock. Stay curious, stay calm, and we'll see you next time.